with the U.S. as it reportedly orders Chinese airlines to stop taking deliveries of Boeing planes and to not buy the aircraft-related equipment from American companies.
They're being imposed a tariff of up to 145%. Now, what we know this time is that the Chinese government has asked its carriers to stop taking delivery of Boeing aircraft in the meantime.
US President Donald Trump has remained firm that China must be first to step up to the negotiating table on tariffs. Beijing has reportedly blocked further deliveries of Boeing jets in retaliation to Washington, D.C.
The ongoing trade tensions between the United States and China have now taken flight, quite literally, into the aviation sector. One of the clearest manifestations of this rift is the turbulence Boeing is currently experiencing. The recent directive from China's Civil Aviation Administration to halt deliveries of Boeing aircraft has sent shockwaves through global markets, triggering a sharp decline in Boeing's share value. This development has laid bare the far-reaching consequences of the U.S.-China trade war, which now threatens not just individual companies or sectors, but entire international supply chains, thousands of jobs, and business worth billions of dollars. To grasp the depth of this crisis, let's delve into the numbers that narrate this unfolding story. As of the end of last year, Boeing had approximately 4,500 aircraft in its global order backlog. Of these, over 1,200 were linked to Chinese airlines and leasing companies, accounting for nearly 26 to 28% of its total orders. With average list prices standing at around $300 million for wide-body jets and $110 million for narrow-body aircraft, sales to China contribute a substantial $10 to $12 billion to Boeing's annual revenue. When long-term maintenance and parts contracts are factored in, the financial stakes rise even further. China's sudden halt in deliveries thus places a significant revenue stream in jeopardy. Following the announcement, Boeing shares plummeted by nearly 10% within days. Analysts attribute this steep drop not only to the suspension of sales, but to growing fears of deeper retaliatory measures and potential long-term erosion of Boeing's market share, particularly to rival Airbus. In 2024, China's combined aircraft orders from Boeing and Airbus totaled approximately $14.5 billion. Should Beijing pivot more decisively towards Airbus or ramp up domestic aircraft production through firms like COMAC, Boeing could find itself limited to just $5 to $6 billion in annual Chinese revenue. This potential loss could translate into a market capitalization dip of up to $40 billion, a scenario investors are now seriously contemplating. But this issue stretches beyond Boeing. Civil aviation exports play a crucial role in balancing the U.S. trade deficit. The United States exports approximately $130 to $140 billion worth of aviation equipment and aircraft annually, a large portion of which is produced by Boeing. China constitutes 15 to 18% of this export market. Losing even the single category of trade means billions of dollars shaved off the U.S.'s export performance. Moreover, Boeing's vast supply chain spans all 50 states, involving thousands of suppliers manufacturing everything from engines and landing gear to avionics and seats. A halt in Chinese deliveries could ripple across this network, threatening thousands of jobs, especially in sectors like engine manufacturing, where job losses could reach 5,000 to 10,000 by the end of 2025. Yet for China, replacing Boeing is no simple feat. While efforts to deepen ties with Airbus and accelerate COMAC C919 and CR929 programs are underway, China's airlines still rely heavily on Boeing 777, 787, and 737 MAX models for long-haul operations. Transition to Airbus would require not only time but significant investment in new pilot training, maintenance infrastructure, and spare parts, costing millions and taking months to implement. Despite these challenges, Beijing appears to be calculating that while both sides will suffer, the United States will bear the greater pain, a classic lose-lose gambit in the playbook of trade wars. The broader backdrop includes U.S. tariffs of 25% to 50% on certain Chinese industrial and technological goods, with threats of even steeper levies. In retaliation, China has imposed restrictions on American agricultural and energy imports, and now appears to be weaponizing aviation. The cumulative value of past Boeing deals in China is estimated at $150 to $160 billion, which could now be redirected to Airbus or alternative suppliers, placing Boeing at a severe disadvantage. Already, Boeing's market value has taken a hit of $15 to $20 billion within just a week. This comes on top of over $20 billion in losses stemming from the 737 MAX crisis during the pandemic. Analysts suggest that if this current impasse lasts 6 to 12 months, Boeing's revenue from deliveries could fall by as much as 25%. Of Boeing's 140,000 employees, around 30,000 are dedicated to commercial aircraft production. A mere 1% drop in profit margin could threaten thousands of these jobs. Thus, what began as a geopolitical maneuver is quickly morphing into a socio-economic crisis. President Trump has publicly condemned Beijing, accusing it of breaching the Boeing deal and manipulating its currency and tariffs to hurt the U.S. Meanwhile, trade experts warn that if no resolution is found, U.S.-China aviation relations could be damaged beyond repair. Rumors abound that Airbus may soon announce a new deal with China for 150 aircraft, a move that could devastate Boeing's remaining foothold in the Chinese market. According to Chinese media, Boeing has sold over $50 billion worth of aircraft to China over the past 5 years. Looking ahead, Chinese airlines plan to purchase more than 500 new aircraft within the next decade. Each sale represents not only $100 to $300 million in revenue, but up to $500 million when maintenance and servicing are included. Should Beijing cancel future purchases, Boeing faces a void that may be impossible to fill. Boeing executives are calling this a politically driven retaliation. Lobbyists have urged Congress to act, warning that a trade war of this scale could lock Boeing out of China for the next 30 years. While some lawmakers advocate for a more flexible tariff policy to protect Boeing's interests, the Trump administration remains steadfast in its broader economic strategy, showing no signs of retreat. Boeing's recorded revenue from China stood at $7.4 billion in 2024 and was projected to grow to $9 to $10 billion in 2025. Now, that figure could dwindle to near zero. If retaliatory measures spill into other sectors like semiconductors, chemicals, or agriculture, the broader U.S. economy could face significant contraction and even recession. Airbus, for its part, remains cautious. "We do not seek to profit from trade wars," officials stated. Yet the company's rising stock suggests that investors are betting on a shift in Chinese preference. If formal orders materialize, Boeing may find itself watching a strategic market drift away. In summary, China's move to suspend Boeing jet deliveries threatens not only immediate revenue, but also potential long-term contracts worth over $150 billion. When factoring in spare parts and maintenance, the stakes surpass $200 billion. This single act highlights how civil aviation, once a symbol of global collaboration, has now become a battleground in an escalating trade war. Unless a diplomatic breakthrough is reached, Boeing may continue to suffer steep financial losses, along with thousands of suppliers and employees caught in the crossfire. For now, both Washington and Beijing remain entrenched. China plays what it views as its trump card, while the U.S. stands its ground. Whether back-channel negotiations or a political reset will intervene remains uncertain. But what is clear is that this confrontation could reshape the global aviation industry for decades to come.